Hello, everyone. Today on this Friday edition of the Final Bar, we will wrap the week. We'll focus on how the market conditions have evolved from last Friday to this Friday. It's my favorite show of the week because we tried to take a step back and look at how the market has evolved. You're seeing renewed strength going into the close today, similar to what we saw yesterday. And that last 30 to 60 minutes really represents institutional interest. Right now, it's buying over selling. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market conditions using the power of StockCharts, using the technical analysis toolkit to try to make sense of things overall from a technical perspective, behavioral perspective. Overall, the S&P continuing to push higher. We talked yesterday on the show about the new Dow theory, looking at the S&P 500 and the Nasdaq composite based on Charles Dow's original conversations, original writings about, looking at different parts of the economy and when they were confirming or not confirming each other. The S&P and the Nasdaq both pushing to new all-time highs this week confirms that new Dow theory buy signal, telling you that the two main pillars of the economy, the old economy, the new economy, are doing just fine. Having said that, though, not all stocks are going up, right? You get sort of a mixed results. A little later, we're going to look at growth versus value. It's been really choppy. It's been sideways as growth and value-oriented names have exchanged leadership positions. So while the S&P is going higher, overall, I think that's encouraging. I think your experience, depending on what particular stocks and ETFs you own, has potentially been very, very different. So let's focus on where the opportunities have been, and most importantly, where the opportunities are most likely going to be going forward. We have great guests on the show. I had a lot of fun with our guests talking through some of the charts top of mind for them. Doug Bush yesterday was a lot of fun. He really knows individual names very, very well, and it's a pleasure to talk with people like that. Coming up next week on Tuesday the 2nd, we have Joe Rabel from Rabel Stock Research. On Wednesday, Chris Vermeulen from the Technical Traders. Week after, on Tuesday the 9th, we have Larry Tentarelli from Blue Chip Daily. On Thursday the 11th, Joe Duarte from Joe Duarte in the moneyoptions.com. Also, two other quick announcements. So if you missed the pitch earlier this week, it was a fantastic episode featuring Grayson Rose and three guest commentators, Jay Woods, Mark Newton, and Greg Schnell, all providing 5 stock ideas each. Go to stockcharts.com/thepitch for a replay of that event. Also, I was speaking yesterday morning with Julius de Kempener from RRG Research. He's a fellow StockCharts contributor based in the Netherlands. I'm sure many of you know of his RRG toolkit, which is featured on StockCharts, but also he's a frequent host and guest on StockCharts TV. He and I will be doing a session at the Money Show Virtual Expo next Wednesday, the 3rd, called Sector Plays Through Year End. We have a really cool event set up where we're going to basically introduce the RRG and think about sector rotation, but also some other different rotational aspects to look at. Then we're going to dig a little deeper into one particular sector, look at industry groups and individual stocks and how they relate to the relative picture that we've laid out. So go to stockcharts.com/moneyshow to sign up for that event. We'll hope to see you there next Wednesday. Let's continue on with our Wrap the Week segment. We're going to begin this weekly wrap exercise answering a poll question. We always have a poll going on our live stream. That's at stockcharts.com/TV. We also send polls out through social media. So do, if you could, answer the poll question anytime you see it. And here is the most recent one. Which ETF performs best through year-end 2021? And we gave you 4 choices. The e-commerce ETF, $iBuy. The FANG Stocks ETF, $FNGS, the Oil and Gas ETF, $IEO, or the Gold Stocks ETF, $GDX. The strongest response we got was for oil and gas, which is actually a bit of a surprise to me. The only thing I can think is that we split up the real growthy investors between e-commerce and FANG stocks, and we managed to, it's like two candidates from one party running at the same time. I think we probably spread you between those two ideas. And then we got all the cyclical people, the value oriented people really excited about energy. And that was enough to drive $IEO to the driver's seat this time. I did not vote in the poll. I'm interested in a couple of things. Number one, IEO. I certainly get the argument for energy, and talking with Greg Schnell about the prospects for energy, the long-term opportunity certainly is there. The strength that you've seen so far in the last 6 months has been pretty impressive, really in the last 12 months, coming out of that October, November low of last year. However, there have been some sort of some different parts to this cycle, and most recently we've been overbought for quite some time. We're just coming out of that overbought region. Certainly suggests that energy is due for, at the very least, a bit of a constructive pullback, but it could do a little bit better going to the end of the year. Whoops, why can I not figure out how to type symbols? FNGS is an ETN, so careful with that particular exchange traded note. Always pay attention to structure and everything like that. The FANG stocks, what's tough about this one, to be honest with you, is they're pretty bifurcated right now. You have stocks like Alphabet breaking out, you have stocks like Facebook breaking down, so they're not homogenous at the moment. That's what's causing that group to be kind of sideways. iBuy is the third one, and that's probably the least attractive, maybe. Aside for gold, the two of those are pretty tough. I think what we're looking for here then is buying on weakness on iBuy for the 21% of you that picked that one. That's a tough sell for me though. I see a bullish momentum divergence, which is interesting. August and October lows and higher lows and momentum might be something to watch, but you need to get back above the 50-day moving average. And I could certainly not make an argument from a technical perspective to be buying gold stocks right here. It just recently came up to its 200-day moving average and fell down. I would probably agree with the masses and go with oil and gas. I appreciate you guys answering the question and putting your votes on the list. Let's wrap the week, or continue our wrap the week exercise. This is our weekly wrap chart, our wrap the week chart. And what we do here is look at the weekly returns. So we're starting the clock last Friday. We're going to this Friday, and we're looking at the returns over the course of the week. To make a chart like this, by the way, I always start with the SPY, or the $SPX as the symbol. And then at the bottom, there's an indicator called price-performance. That allows you to add these different series onto the chart as well. And if you make the type of chart a performance chart, it's sort of like a perf chart that we have elsewhere on the system, but it incorporates it into the Sharp Charts dashboard. So you can do annotations and do cool stuff like that. So this is the way I do a lot of the relative performance, just to sort of look at how things have performed over a period of time. Having said that, the S&P 500 is here, finishing the week in the positive, 1.4% higher than we were at last Friday at this time. A couple things have outperformed the S&P, or large cap stocks, this week. This is bond prices, the TLT, up 2.5%. The big winner this week is the Nasdaq 100, up 3.2%. Everything else on the list underperformed. Here's in green, we have the US dollar, and we're using the UUP for this, but it's up 0.5%. Also up for the week is small cap stocks, is the Russell 2000 ETF, up 0.3%. All the others were down for the course of the week. Gold prices down 0.7%. That's using the GLD. In brown, we have crude oil prices using the USO ETF. That's down 1.5%. The worst performer of the bunch, emerging markets, down 2.2%. That's EEM, the broad emerging markets ETF. So it's interesting this week. It's actually quite a spread. Some weeks, a lot of things are sort of clustered in a certain place. This was one week in particular where we saw quite a spread from the top performer up 3.2%. That's the Nasdaq 100. The lowest, or the worst performer, emerging markets, crude oil, down over 0.5% each. So, I think now more than ever, it really behooves you as an investor to pay attention to where the returns are, because again, depending on what you own right now, your experience over the course of a week like this could be vastly different, right? Now, we did not add Bitcoin on the list. Here's another chart incorporating Bitcoin. I usually throw it in at the end just because it tends to be way more volatile. It skews the whole look of the chart. But Bitcoin actually finished up as one of the top performers, just below the Nasdaq. It was up 2.8%. That's using the Bitcoin spot rate, basically $BTC USD. So overall, constructive. And Bitcoin, as you know, Ether as well, breaking two all-time highs, coming down, kind of chopping around a bit, but in the going into this weekend starting to appreciate. And I think looking at the chart of Bitcoin, it'll be interesting to see with Bitcoin, Ethereum, with some of the other major coins that we follow. Do you see further appreciation? Do you see further buying power that's building up and propelling those those coins to further upside. That's certainly what I'd be looking for. Through the remainder of our time together, we'll be using the Mindful Investor Live chart list. This is a chart list that I maintain on StockCharts.com all the time. To get to this, by the way, if you've not seen the Friday show before, if you go to the Articles tab at the top of StockCharts, in the upper right, you'll see all our blogs listed out. Mine is called The Mindful Investor. If you click that off, you can see this little gray button that says Live Chart List. That will bring you to this list of charts. You're welcome to explore them, save them, send them to your friends, whatever you like. Chart number one is the market trend model. This is something I designed years ago that I've been following, and my goal was to come up with 3 different time frames to, at a glance, using weekly data, get a sense of long-term, medium-term, short-term trends. And the long-term trend has been positive for over a year now. That's since June of 2020 when it turned positive. The medium-term model for me turned negative in May. And this is very simple, just using the weekly MACD, or in this case, we're actually using the weekly PPO, but very, very similar, almost identical signals that you get. It's actually a really interesting one. Given the strength that we've seen in the last couple of weeks, the weekly MACD is really close to generating a buy signal. It did not quite do it this week, but if you see further strength, if you see S&P making new all-time highs into next week, you could potentially see a buy signal from the medium-term model. For me, that's been negative since May. Which has been, indicating really some weakness. And, I've thought a lot about this model, and I'm actually tinkering with some different looks for the medium term portion of the model. But, what's interesting to me is this turned negative in May. And the reason why, to be honest with you, is because the pace changed quite a bit. If you look at late 2019, the S&P sort of chopping around in the middle of the year over the summer, and then really accelerated to the upside. And you saw the model remain very, very positive there toward the end of the year. Here, you actually saw a lot of strength, and it's actually started to slow down a little bit, right? The moving averages are sloping downwards a little bit, coming together. And that's what caused the MACD to give a sell signal in May. And it's never really recovered from that. It's gotten close, but it's never really done that. So really suggests caution here for quite a while, but very close to giving an all clear yet. Again, the short-term model, by the way, has been positive for the last 3 weeks or so. Next chart, the S&P 500 daily chart. We review this most days on the show, and again, as Paul Montgomery, legendary technical analyst, once said, the most bullish thing the market can do is go up. I will also quote another famous technical analyst said that the worst. I'm paraphrasing this one, but basically the worst mistake an analyst can make is remaining bearish in the face of a rising market. So I told a media outlet to remain unnamed a couple of weeks ago. I'll remain cautious unless we get to new all-time highs. If we get S&P above 4550, I will be forced by the evidence to turn bullish. The market has gone above S&P 4550 as promised. It's a constructive tape. It has to be. Again, talking with Julius de Kempener yesterday, we talked about the S&P, and we both sort of agreed. We're surprised that so far this year, which had the potential to be kind of rocky at times, the most we've seen is a 5 to 6% pullback. We saw that in the first quarter. We saw that again in the third quarter, going into the beginning of October. And overall, that's been it so far. Now, we could see weakness in the next couple of weeks. We could see weakness between now and year end. But just like strength in May through October, that's the seasonally weakest part of the year. So you should be surprised by strength May through October. You should be surprised by weakness November through April. Starting Monday, we are now in the seasonally strongest part of the year, which tells me, is it possible that the S&P goes down and tests 4050? Of course it is. It's certainly possible. It's possible the S&P goes down to 3700. I think that's highly unlikely, but it is indeed possible. However, is it probable given the seasonal trends? Absolutely not. And what you have to remember is now we're entering the period where the market usually appreciates just fine. It's usually shrugged off the September, October period, and then you actually strengthen into year end. So if we would show weakness in November, we would have completely flipped a seasonal model that many investors have been following for decades. So it's not unheard of, but it would certainly be unusual. The cumulative advanced decline lines are very subjectively color-coded. This is the New York Stock Exchange common stock only on the top. Then we have large caps, mid caps, small caps. I've color-coded them. 2 of these I've switched back to green, and that's the large cap and the NYSE common stock one, because both of those have gotten clearly above their September highs. They're making higher highs now, higher lows, and I have to acknowledge that the breadth picture has improved. The mid cap, and small cap both are really close to breaking above their September high, but have not quite done it. And I'm seeing that as I would need to see that to turn these into the green bullish color, but overall the breadth conditions have certainly improved here as well. The percent of stocks above their 50-day moving average was around 25% at the end of September. We're now to 65% at the end of October. So in about 4 weeks, 40% of the S&P, that's about 200 stocks, have rotated from below their 50-day moving average to back above, just like the S&P itself has done. So that is overall the conditions that are more consistent with the bull market phase. That remaining above 50%, by the way, I would argue is one of the pieces of evidence that would encourage me to remain bullish. An expansion in new highs is pretty standard for a bull market phase. That's what you would normally want to see. That had been the case up until this week. While we still have a healthy number of new highs, we're seeing less and less through the course of this week. This isn't quite updated for today's trading just yet, but once it is, that'll be something to look at as well. I would be interested going into next week as the S&P and the Nasdaq finishing strong, making new all-time highs. Do you see a continued expansion in new highs? That's the sign of a strong, healthy bull market phase. Another one would be the bullish percent index getting above 70%. It's actually been below 70% since June, which is called a bear alert. That's when overall the conditions are very positive, with over 70% of the S&P in a bullish point and figure chart. That changed when it goes below 70%. That's called a bear alert. We've never really gotten much worse than that. It's sort of remained in this 50 to 70% no man's land of not super bullish, but not really super bearish yet. Getting back above 70% was a good indication in March that conditions were starting to improve. Again, I would be looking to see if that sort of pattern improves going forward. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So good to have you join us every weekday after the close for our show, especially on Friday when we can wrap the week and answer some of your questions from the Final Bar Mailbag. By the way, before we open the mailbag and answer some of your questions, all of those questions come from you, our viewers, and most of them come via email. Shoot us an email with any of your questions as you are analyzing your own charts, things you're seeing or hearing in financial media, stuff that's coming out of your own process or that you're seeing on social media. Shoot us an email, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer yours in our next mailbag segment on Tuesday's show. Also, do me a favor, go to stockchartstv.com. That is our on-demand platform. There's so much great content that our team puts out every trading day, even sometimes on the weekends. Great special events like The Pitch, our year in review coming up in December, our 2022 market outlook that we're planning for January, great shows like the Final Bar and others, and fantastic guests like some of the ones that come through this show a couple times a week. Go to stockchartstv.com. It is free to set up an account. Just use your email address. You can also, on your mobile device, go to the App Store, search for StockCharts TV on demand. Our next segment is the Final Bar Mailbag. These are questions we received from you in the last couple of days. Again, shoot us an email with any questions that come up in your process of using technical analysis and using stock charts. The Final Bar @stockcharts.com is our email address. And let's get to question number one. Can you please explain how one can screen for stocks entering a MACD buy signal? Great, absolutely great question. And I am not the foremost expert on our scanning engine. I use it every day, most days, to be honest with you, but there are others that use it even better than I do. And I would encourage you to look. We have a show that we've updated sometimes. It's been a little while, but there's a show, Deep Dive, with Chip Anderson. If you look on our on-demand platform, you'll see some of the sessions he recorded. He helped obviously create and design most of the platform, particularly the scan engine. He's done a really good job of sharing some ideas of how to set up screens. Bill Shelby also is a real expert on the scanning engine and helps manage it for us. If you see any videos on our YouTube channel from Bill, I would certainly check those out as well. Here's what I would suggest: two things. Number one, if you go to charts and tools on the top, there's this thing called predefined scans. And this is a really good place to start, because what this is we basically have a bunch of pre-set up scans that we've created. They're a bunch of things. So you're asking for what's called a bullish MACD crossover, which is basically a buy signal where the MACD line crosses up through the signal line. A bearish MACD crossover would be down here, and you can click on any of these numbers to see a list of those stocks that fit that criteria. Now, the other thing you can do, of course, is go right to the scanning engine. So from your dashboard, you're going to see a little thing that says scans, this little gray button. If you click that, you're going to get to your list of scans, and hopefully you've created some. If not, just say new scan here in gray. This will give you to this stock, the scan workbench is what we call it. Now, if you are big into coding, you are welcome to learn this language and add each of these lines and write it in order and do all these things you want. And I know some people who are very, very good at it and love that capability. That is super not me. I am not a developer by any stretch of the imagination. So I love the drop-down menus at the very bottom. If you click on where it says predefined scans, all the things on our predefined scan list are in here. So if you say bullish MACD crossover, what it's going to do when you click add is it's going to add the stuff you need in the StockCharts language to teach the thing that you're looking for MACD crossovers. And what's cool about that is you can start searching for other things. So stocks with a high scooter ranking or a bullish point and figure chart that are giving a MACD buy signal in the last X number of days. It's really unlimited in terms of what all you can do and combine different criteria. And that is the answer to your question. Question number 2, when do you consider a sector overextended? Is it a certain percent above a 50-day moving average? Now, that's a really interesting question. I love the question or the comments embedded. The answer embedded in your question is actually an interesting one. And it makes me think in ACP, in StockCharts ACP, we have a really cool indicator showing the percent above or below a moving average. And what's interesting about that is you can actually take a stock, a sector, and again, this is not necessarily particular to a stock, but could be anything. But you can basically say, how far is the Apple from its 200-day moving average? Currently about almost 10% above its 200-day moving average. That's there in red. So when a stock has had a pretty good run, it tends to get really extended from that moving average. And, excessive percent moves above the moving average is something to be concerned about, only because, and the reason is because the moving average gives you an overall trend for the stock. And even if that trend is consistent, you will have periods where you're extended above the moving average in an uptrend, and on a downtrend, you'll find when it's, the sellers have become too aggressive and put it down there. So that particular thing, no, that is not something I would normally be looking at, although you can do it. And that, what I just showed you, is the way that I would make that comparison. For me, it's a number of things. For me, the number one thing I would be looking at is when something is overbought or oversold. And looking at the RSI is a great way to do that. So if you look from November of last year, really through where we're at now, this is the last 9 months or so, 11 months or so, as energy overall has appreciated on a relative basis, for the most part, has done very well. You see a number of times where it's overbought. You can see there's usually a bit of a pullback. Even though the trend overall has been positive, those overbought conditions tell you that it's gone a little too far too quick, and it's probably going to pull back a little bit. So I would use RSI to try to answer that question. A percent above a moving average would be another way. And there are a number of other things as well that would try to help you indicate that. Last comment I was making is it's very much about your time frame, right? So make sure that that indicator you're looking at is in line with the time frame of the questions you're trying to answer as a trader, as an investor. Next question: in your DK morning breadth indicators chart list, you use $ADLINENYC and $NYAD cumulative. What is the difference between the two indicators as the charts look different? Yeah, really good question. So I was actually talking with Grayson Rose earlier today. We were working up a breadth homepage on StockCharts. So at some point, not yet, but at some point, hopefully you can run stockcharts.com/breadth, and you'll get to this really cool page where we have all of our breadth data and we explain how to use it, and link to some educational stuff, but really give you a homepage to understand the breadth characteristics. That will come. It's not happening yet, but we've recognized that we have great breadth data, but it's in a lot of different places. And I've learned a ton from asking people like Arthur Hill and others, and Grayson, people that use the breadth data regularly. They've been really helpful at pointing me in the right direction. So the indicators I'm actually using to create this chart, which is the main one that we look at a lot, is the first one you mentioned, $ADLINENYC. And you can see these other tickers are on here, and you can use those. And these are cumulative indexes. So we have taken the daily advanced decline data, we have turned them into lines. And I'm just going to butcher my chart here for a second. Let me get rid of this one, get rid of this one. I'll try not to save this, but you were talking about $NYAD. So $NYAD is actually a daily value that is giving the daily advancers decliner. So a cumulative line like this is basically taking this daily data and running a cumulative series. So it's basically add or subtracting the daily data, and then you have a continuous series. The other thing you can do is you can turn this chart into a cumulative measure, and then it's basically going to do the adjustment for you on the fly, and it's going to turn that single, these daily points and turn it into a cumulative line. Now, we give you those different options because there are a lot of different times when you may want the daily AD values. You may want to create a cumulative line for that particular series. You may just want to chart the cumulative line. So we have all these different combinations. So that is how we create these charts, and that's why they look different. Now, that's how you design them. Now, why do these charts not look identical? And it has to do with the issues that are included. You'll note that when I'm doing this series in particular, this ADLINENYC, the C actually stands for common stock only. So the challenge with the New York Stock Exchange is it's a lot of things. It's not just equities. They're also closed-end funds like bond funds and other things that are traded, that are listed on the New York Stock Exchange. They don't actually represent common stocks. And people like Lowry, Paul Desmond, and others. Lowry's research is a well-known breadth data analytics firm based in Florida. Guys like Michael Kahn are there now, but people like Dick Dixon and Paul Desmond and others did a fantastic job popularizing their breadth analytics for years and years. And he was very big, Paul Desmond, on using common stock only data and eliminating the stuff that's not common stock. So that's why I'm looking at that. This NYSE AD issues is actually looking at everything. So it's including some of those closed-end funds and other stuff. So that's why the data series may look a little bit different. So this is why we're hoping to set up a breadth homepage, because we're finding there are a lot of challenges with this data, because there's a lot of different sources, a lot of different ways we can present it. We will try overall to make this easier and easier to make sense of, but that is the answer to your question. That is all the time we have for the mailbag. Listen, I really appreciate your questions. We'll please keep them coming. We'll get to more of them on Tuesday's show next week, but we need to wrap today's show. Go to the 3 and 3. 3 charts in 3 minutes. Here we go. Chart number 1 is what I call the sell in May chart. Congratulations. We have made it to the end of the seasonally weakest 6 months of the year. We are now embarking, starting on Monday, the seasonally strongest part of the year, November through April. Now, the reason why I'm bringing up this chart is I'm actually starting this chart on April 30th of 2021. We are ending this chart today, and you can see if you own large cap stocks, you've had a pretty good 6-month period. And even though it's been the seasonally weakest part of the year, we're up 10% looking at the SPY over that period. All the other indexes are essentially unch. They're essentially a flat performance for the entire period. So if you think about your experience as an investor over the last 6 months, when I think about my medium-term trend model being negative, I think it's captured the weakness in mid caps and small caps and micro caps, which have essentially been flat for the last 6 months. Again, during the seasonally weakest part of the year, they've actually done what you'd expect the markets to do in the seasonally weakest part of the year. What's not been weak necessarily has been the S&P 500, which overall has appreciated just fine. Now, again, it's not ever a guarantee that May through October are going to be down or that they're going to be negative months. It's just in general, the market tends to be much stronger in the other part of the year. So it's interesting that that is the dynamic leading into November through April, which tends to be the strongest 6 months of the year. Thinking of it another way, this is the equal weighted S&P versus the cap weighted S&P. So this is a ratio of the RSP, which is an equal weighted S&P 500 ETF, versus the SPY, which is the normal cap weighted ETF. This is making a new 6-month low this week. So overall, equal weighted underperforming cap weighted, meaning the large cap, the mega cap stuff is still doing much better than the other cap tiers. Finally, we have growth versus value. And I'm bringing this chart up, even though this ratio is potentially breaking out. The last quarter has essentially been sideways. Growth and value have both been taking their own turns in the leadership position. My question between now and year end is, where do we see the outperformance coming from? I would tend to think it's more of the cyclical stuff, things like industrials and energy stocks and financials. But this ratio breaking out is telling me no, it's more the growthy stuff that is working right about now. Folks, that is our show and a wrap for this week. on the Final Bar. I want to thank you so much for joining us every weekday after the close for our show. As a reminder, go to StockChartsTV.com for all of our previous interviews and episodes. Big weekend for two reasons. Number one, Ohio State versus Penn State. My brother went to Penn State, so go Bucks. And number two, have a happy Halloween, be safe, and enjoy the weekend. We'll be back with you next week. Take care.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.